Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, home equity conversion mortgage programs, part 2 of our series on home equity solutions in retirement with financial advisor Eric Brasch. Thank you, Eric, for coming on the show.
Thank you. It's great to be here.
And let's be brash here. People are not going to be many people watching this for the first time are going to hear some new information, not only this segment, but the following succeeding segments. Because this could be a game changer.
Correct.
And after 2008 market meltdown, after the 401k debacle in the market, I mean, housing, everything, most seniors, we just started recovering last year. So we're not in the pink yet. We're getting better.
Most people that had money placed during the market crash of 2008 have gotten most of it back, but have not gained anything. So that's a 5 to 6 year window of not gaining any interest or any additional income.
So we're par.
Correct.
We shot par, for
exactly.
6, 7 years. Wow, great.
Par is great on a golf course, but it's not good in financial planning.
Yeah, well, my game's not par. Okay. So, well, let's talk about the first thing, HUD. Who is HUD? I know it's a government. Who is HUD? Why are they involved?
Housing and Urban Development, which is HUD, is kind of the overseer of any transaction of a home in the United States. They don't guarantee loans, but they insure basically for when the equal rights of everybody that's purchasing a home through various means. Think of them as the dad. They oversee everything that happens with regards to mortgages and home building and home purchasing in the United States.
Now, the only real issues with HUD is just the same thing it would be for anything. Do I have credit worthiness?
Correct.
Do I have do I have income? Do I have a job? Do I not have a job? If I'm self-employed, I'm going to have to go through some extra hoops here.
Exactly right.
Okay, so HUD's the big overlay housing authority.
Correct.
But now it's also insured by the FHA. Talk a little bit about why does that matter, and especially what we're going to get into, why it's really good.
An FHA loan is Fair Housing Administration. They are the insurers of all government-backed loans, government underwritten loans. There's several different ways. There's a conventional loan, and then there's a government loan. Government loans, an FHA would be a government loan, a VA, Veterans Association government loan. So the guarantee comes with the full faith and backing of the United States government, which makes it easier to qualify from a legal standpoint of the lenders that we work with, because they know that the government's going to take care should something happen to this home.
Okay, now I notice in traditional mortgages, at least today, people can come with 3% down, and they're pretty much, they qualify on the credit side of that. And even in our state of Arizona, there's grants to be had that don't need to be paid back. So between the FHA and housing grants, if you qualify on the basis of income, you could still get a home here.
Correct.
Okay.
There are several local and nationwide factors where you could qualify with no money down based on some government grants and some subsidies.
I guess we didn't learn our lesson of the 2008 housing debacle. All right, fair enough. But now FHA's involved, and we're talking about 3 basic premises of home equity conversion mortgage. Let's talk about the first one, tax-free income.
Correct.
Can I take this? I'm taking an equity position for my home. It's insured by the FHA. Could I take a lump sum and just take it that way?
Yes, there's several factors. There's several ways to do this.
Yeah.
You could take a lump sum. That's typically of the 3 options that you really have. I think that's probably the worst of them. Not in the sense that it's a bad thing, but there's better benefits other ways. When you take the lump sum, that's the lump sum. That's what you get.
You're done for this. For
exactly
your
right.
And do people? I'm just sorry, but do most consumers burn through it?
Very much so.
Okay, so there's a big problem. It's hard to recommend from an advisory point of view to give you a 6-figure lump sum, because are they going to really be able to take care of it?
Right. Now, having said that, there are situations where the lump sum is a good idea. If it's a situation where there's a medical situation where you need the money up front immediately now, those kind of things.
Okay.
Some people will even say, you know what, I want to take this lump sum. I'm going to spend some of it. I'm going to invest some of it in something else that happens. We're allowed to do that in certain circumstances. But that's the first option that I tend to steer clients away from that
Yeah, we
because
really want to take ongoing annual. I'd love to see lifetime guaranteed, tax-free. And remember, this doesn't show up. We'll get all that in the next segment.
Sure.
Let's talk about purchasing a home. This is the killer for me. I mean, I was like, what? When I first heard this a couple years back at the American College, if you're 62 years old, all these are requirements, right?
62 is the requirement. That's the threshold.
Has to be your prime residence.
Primary residence, correct.
And we recommend that you pretty much you need to think about living in this house till you die.
Correct.
I mean, you can get out, but there's different issues. Purchasing a home, I noticed that the last one I saw was that you could buy a home for about half the total value of the home if you had a lump sum deposit, and you're done. You have no mortgage payment.
That's correct. That's correct. You literally can purchase a home 50 cents on the dollar is kind of the threshold number we like to start with.
Or less if you're older.
Or less, depending on how old you are, correct.
Well, to me, this is every time I bring this up to people, normal people, I'm in conversations, I'm at a restaurant with some friends, right? They go, no, that can't be right. Well, no, I just, it is right. And so this is another application of the HECM laws,
correct.
Home equity conversion mortgage, and that could be purchasing a home for less than, or half or less, depending upon your age. And then the third one, this is the one that really I find somewhat exciting, and of course this has been in the press now for the last 3 or 4 weeks, because people are wondering if this is just too much giveaway by the government to regular seniors. And that is called an appreciating line of credit. Now, we're going to get into this in the last segment about what's a HELOC, what's a HECM equity line. But basically, the word appreciating is the thing that first caught my ear 2 years ago. Appreciating equity. What does that mean?
So with a standard home equity line of conversion or HELOC, you have a set number based on the value of your home and based on the ratio of what you owe versus what it's worth. That's your loan to value. That doesn't change. When you do the home equity line and you have a $50,000 home equity line, you don't get to go back and say, well, my house appreciated last year, I need more. That doesn't work like that unless you do another refinance.
Now, it could work in the other way too.
Correct.
Your value of your home could be depreciating, right? Market value is crashing.
Exactly.
They're not going to come back and call this note.
What they have done in certain circumstances in 2007 and 8, where we saw this the most, was you had a home equity line and your house deteriorated in value, they will freeze your line. So you can't have access to it. So if you had a $100,000 home equity line that you didn't tap into yet, and all of a sudden your house depreciated by $50,000, they will freeze your line of credit, thereby not letting you have it.
So they could do this under HECM.
Yes, they can.
Okay, so my guess would be you might want to jump on it if you see deteriorating costs.
Exactly.
All right. Okay, but that I understand because HELOC's much more punitive than this. Okay, so I just want to make sure as we recite the things under HECM. Now, the first section we talked about the 3 in the generic: Social Security, Medicare, and the HECM laws.
Right.
Here we're talking about HECM itself. It's under HUD. It's under FHA. You got to be 62 or older to participate.
Correct.
The complete value of the home cannot exceed $636,150.
That's correct.
You can buy the home. You're going to have somebody's got to be 62 in the married. If you're married, somebody's got to be 62.
Correct. And then you have what's called a non-occup or a non-borrowing spouse if that person is less than 62.
Now we're going to get into is that a good deal or a bad deal in a second. Okay, appreciating line of credit again too, and right now I think it's at what 6.1 or something like that.
Yes, correct. Yes, 6.1%.
And of course, this is at the time of
and
our
that was I started to say that was the difference between the home equity line of credit and the home equity conversion line. Is the fact that it will increase, and it does increase. That was the second option of, do I take a lump sum or do I take the line of credit? That's our third option typically. Typically that's reserved for somebody who doesn't really need the money yet, but it's there if you need it.
Well, we're going to get into it because I think it could be a monster backstop.
For sure.
Or a financial risk. If you're down to your last dollar, bang, that's where you'd go because that would be a great place to look at. Remember, we're talking about all these things, because these are programs that the government put together. Most people are pretty knowledgeable about Social Security. I say that, and then when I review people's portfolios, they look like they took it way too early.
Right.
Medicare the same way. It's means tested. Just remember, especially if you're buying Medicare supplements, if you're not that healthy, I'm sorry, you're just going to need to spend the money. Don't do a Medicare C Advantage plan. If you're not that healthy, you're really going to be putting yourself in harm's way. If you feel like you are healthy, though, and you've led a pretty good life and you have very little bit of hospitalization, no premiums.
Right.
That could be the way to go. And again, remember, we're adding more premiums on. It's just taking away from our net to get the mortgage,
exactly right?
Well, that's what we're trying to figure out, and that's what we're trying to avoid. Don't forget to watch our next segment on home equity can generate tax-free income, part 3 of our series on home equity solutions in retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.